Hi everyone, I hope you are staying healthy with your family and friends. In this video, we are going to learn about 12th Standard Accountancy, Chapter 5, Admission of a Partner, Introduction. Admission of a partner is one of the most important topic and one of the most scoring and many number of questions are asked from this chapter. I will explain you clearly everything about the admission of a partner. Very typical, many typical and comprehensive questions are asked from this chapter. So watch this video fully. Okay. So and what are the topics? What are the chapters you are required to learn? Please comment it in the comment box and I will teach you accordingly. Okay. Let's come to the topic: admission of a partner. What is the other name of a new partner or admission of a partner? The other name of the admission of a partner or new partner is called incoming partner. Okay. So what is meant by admission of a partner? Admission of a partner on admission of a new person into the firm is reconstituted with a new agreement. Okay. What is meant by reconstitution? Listen, the existing partner named as, say for example, the existing partner named as A and B. Okay. They run the business successfully. They run the partnership already successfully. They share their profits as per the profit sharing ratio. Okay. So both A and B decided to admit a new partner. Okay. So the existing partnership agreement is comes to an end. On the admission of a new partner named as C. Okay. On admission of a new partner, the new partnership agreement comes into the picture. That is called reconstitution. Okay. Then, why the existing agreement comes to an end? Because, listen, existing partners named as A and B run the business successfully for past 10 years. Okay. So, they sharing their profit sharing ratio equally. They share their profits as per the ratio equally means 1:1. Okay. So, 1:1, the old profit sharing ratio 1:1 means 1 plus 1, what? 2. Okay. So, if at the end of every year they get the profit, they share their profit. Okay. So say for example, they in previous year they get the profit at the end of the previous year 30,000 rupees. How do they share their profit? They share their profit equally. That means 1:1. Okay. So 1 plus 1 equal to 2. So you have to write the ratio 1:1 on numerator. A's ratio 1, B's ratio 1, and the total sum of the ratio is 2. Okay. So the total sum of the ratio you have to enter it on denominator. So 1/2, which means half. So A's ratio of B's share. So say for example, A and B existing partner have one dosa. How they share that one dosa? They divided that one dosa into 2 equal to halves. Okay. In that means half A share their profit 1 is profit 1. B share its profit half. Okay. Both are divided into 2 equal half. So at the end of the year they get the profit, say for example 30,000 rupees. How they share their profit? As per the ratio of 1:1. So A share 30,000. How A share 30,000 into 1/2 and 30,000 1/2. Okay. So 1 2 is 2, 15 2s are 30. Okay. So these 3 0 is to be added here. So A's profit is 15,000. According to same, B's profit 1 2 is 2, 15 2s are 30. So B's profit is 15,000 rupees. Both are divided equally. That 30,000 profit, 15,000 each. Okay. So on the admission of a new partner, the existing partners agreement is comes to an end. Okay. On the admission of a new partner, the firm is reconstituted with the new agreement. So existing partnership is comes to an on the admission of a new partner. New partnership agreement is comes into the picture. Okay. Are you clear? Then come to the next topic. Sacrificing ratio. What is meant by sacrificing ratio? Say after on the admission of a new partner, the firm is reconstituted with a new agreement. There are two partners in the existing partnership firm. Now, on the admission of a new partner named as C, now including this new partner A, B, C, three partners combined together, join to form the reconstitution, new agreement, new profit sharing ratio. That means 1:1:1. Okay, they share their profits equally, 1:1:1. So the total sum of the profit sharing ratio is 1 plus 1 plus 1 equal to 3. Okay, so say if they get at the end of the accounting period, if they get the profit 30,000 rupees, same 30,000 rupees, we take an example. Okay, how they share that 30,000 rupees equally in new profit sharing ratio? Listen. So one is, as per the new sharing ratio 1:1:1, you have to enter that new sharing ratio 1 on numerator. Okay, A have 1, B have 1 and C have 1. You have to enter it on numerator. The sum of the profit sharing ratio total you have to enter into denominator. So 1/3. A has a profit sharing ratio 1/3, B is 1/3, C has 1/3, right? So if they get the profit at the end of the year 30,000 rupees, how they share it as per the profit sharing ratio. So after cancelling, 1 3 is 3, 10 3s are 30. This 3 0 is to be here, say 10,000, 1 3 is 3, 10 3s are 30. Okay. So A, B, C accordingly they share the 30,000 rupees profit, 10,000, 10,000, 10,000 accordingly. So listen here, the same 30,000 rupees previous year what they get here, on the current accounting period they get the profit same 30,000 rupees. Here A has his profit is 10,000 rupees, B's profit is 10,000 rupees. As per the new profit sharing ratio, C get 10,000 rupees, right? Listen, in previous year A's profit 15,000 rupees and B's profit is sharing profit is 15,000 rupees from 30,000. Okay, here A's profit is 10,000, B's 10 and C has 10,000 rupees. Listen, from 15,000 rupees A sacrifices 5,000 to C. In the same way, from the 15,000 B sacrifices 5,000, 5K means 5,000 to C. So both is sacrificing their profit to give it to C. 5,000 plus 5,000, C get 10,000 rupees profit. This is called profit sharing ratio. Do you understand? Listen, what is the reason to admission of a new partner? There are many reasons. There are many purposes. Admission of a new partner. Say for example, A and B run the existing partners run the business past 10 years. Listen, this is 2014, current year is 2024. Okay. So since 2014, existing partner named as A and B run the partnership business very successfully. Okay. So in previous years, the accounting period is say from January 1 to 31st December. Okay. So in previous year, January 1 to 10 months, October 31, they worked hard, they get the profit 30,000 rupees, say for example. Okay. So on the 10th month, previous year on the 10th month, A and B both the existing partner decided to admit a new partner. Okay. So what is the reason? There are many reasons, there are many purposes they may be admit a new partner. Say for example, I will give you some examples. If they expand, if existing partners borrowed loan from the bank, okay, they can't be able to close that loan. So they need a fund. So for that, A and B decided to, the existing partner decided to admit a new partner, because new partners brings the capital. From that capital, the existing partner close the bank's loan. So for that purposes, maybe A and B decided to admit a new partner. Okay. The another reason is to expansion of the business. Existing partners run the business partnership business very successfully. They needed to open new branches. So for that they needed fund, they need capital. So for that they admit a new partner. They decided to admit a new partner to the expansion of the business. And third one, for managerial skills. New partner has the talented and the managerial skills. So existing partners need more managerial skills. So for that they may be decided to admit the new partner. Okay. Then for goodwill, listen, for past 10 years, since 2014, the existing partners A and B run the partnership business very successfully. It's not for past 10 years, since 2014 to till date, it's not easy job. It's not easy one to run the business successfully. Okay, so they get some reputation from their customers. They sacrifices the customers' needs and wants. So they earn some goodwill from the past 10 years. So they want to increase their goodwill, their business goodwill. In the same way that partner C has a, in the similarly partner C, the new partner also run the separate business for 20 years, since 2004 to till 2024. So partner C run the business very successfully. It's not an easy one. So the new person get some reputation, earn more goodwill. To increase the goodwill, existing partner, to increase the goodwill one, maybe the existing partner needs goodwill, increase their goodwill, firm's goodwill. They needed to admit a new partner. Okay. Then for popularity is the important thing to increase the development of the business. Okay, the familiar person among the people and celebrity, it's easy to reach their business, easy to reach the people. Their product easily sell to the people for their familiar face, famous figures and popular person. So they decided to admit a new partner as a popular person, familiar person among the public and celebrity. They decided to admit a new partner as a celebrity to sell their product very easily, reach the people easily. Okay. Then for commercial area, so listen, the existing partners A and B also run the business on the commercial area, but in previous year they have some lacks, can't able to update their business. So they decided to admit a new partner. New partner also run the business in the commercial area. So to meet that commercial area, so existing partner decided to admit a new partner. So these are some reasons, some example, some reasons, some purposes admission of existing partners decided to admit a new partner. Okay, clear? Okay. Then what are the challenges that will happen on the admission of a new partner? There are many challenges on the admission of a new partner. Many changes will happen in the firm, but mainly on the admission of a partner, become liable for all the activities carried out by the firm from the date of the admission as a partner into the firm. Okay, so liability is very important. Liable for all the acts from the date of admission as a partner into the firm. Okay, so then what are the adjustments are required at the time of the admission of a partner? Okay, here the following adjustment, there are 5 adjustments is given here. These following adjustments are required to at the time of the admission of a new partner. Let's see one by one. Distribution of the accumulated profit and losses and resources, revaluation of assets and liabilities, new profit sharing ratios and sacrificing ratios, adjustment for goodwill, adjustment of capital, on the basis of the new profit sharing ratio if so agreed. Let's see one by one in detail. Distribution of the accumulated profit and losses and resources. Listen, Profits and the losses of the previous year is not distributed to partners are called accumulated profit and losses and resources. What is meant by accumulated profit and losses resources? Profits and losses and resources of a previous year is not distributed to the partner are called the accumulated profit and losses and resources. It should be, so any resources, profit and losses belongs to the old partner. Hence these should be distributed to the old partner as per the old profit sharing ratio. Okay, that is called distribution of the accumulated profit and loss and the resources. Okay, then revaluation of the assets and liabilities on the acquisition of a new partner, the existing partnership is comes into the game. Okay. Okay, new partnership, new agreement is to be on the picture. Okay, so on the admission of a new partner, assets and liabilities should be reevaluated. Then new profit sharing ratios and sacrificing ratios. Recently already on the admission of a new partner, reconstituted. The firm is to be reconstituted with a new agreement. Okay, so they should, the existing partner with the including new partner, they make the new profit sharing ratio for reconstitution. So new profit sharing ratios and sacrificing ratios we already discussed. What is meant by sacrificing ratio? We already discussed. Okay. So existing partners is sacrificing their profits to give to the new partner. Why they give it sacrificing and give the profits to the new partner? Because the new partners bring the capital, right? Managerial skill, talent. He is a celebrity. He maybe gives a commercial areas. So existing partners should share the sacrificing their profits as per the sacrificing ratio to the new partner. Okay. Then adjustment of for goodwill. The existing partners already run the business since 2000. For 10 years, 2014 to till the current year. Okay, so they earn some goodwill. Okay, on the admission of it, they decided to existing partner decided to admit a new partner. New partner also have earned some reputation and some goodwill because he is also run the business for 20 years. Is not an easy one. Okay, for current today's world situation is not a easy job for, since they run the business for past 20 years to till date. Okay, so new partner also on the admission of a new partner also have the earn some goodwill. So goodwill should be adjusted on the admission of a partner. Then adjustment of capital and new profit. Existing partners also contribute to their capital. New partner also on the admission of a new partner maybe bring the capital in the name of cash or check, capital in the name of assets or commercial areas or goodwill or managerial skills like that. So a new partner also come with some capital. Existing partner also have a capital. The capital should be adjusted on the admission of a new partner, and the new profit sharing ratio should be to be adjusted on the admission of a new partner. Okay. Then how to pass the journal entry on admission of a partner? Okay. Listen. On admission, a new partner brings a capital. Maybe it's a cash. Okay. If the new partner brings a capital in the name of cash, cash account is to be debited. Okay. If the new partners on the admission, new partners maybe bring the check, bring the capital in the name of check. So bank account is to be debited. If on the admission, new partners maybe bring the capital in the name of asset account should be debited, is to be debited. So new partner on the admission, new partner maybe bring the cash or bank check or asset, it should be debited, and partner's capital account should be credited, is to be credited. Clear? Then how to form the journal entry to transferring accumulated profits and reserves. Listen here carefully. Accumulated profits and reserves. How to pass the journal entry to transforming accumulated profits and reserve. What is meant by accumulated profits? The profits and losses of the previous year is not distributed to the partner or called as accumulated profits, shares, and profit and losses and resources. Okay. Reserves. Okay. So in previous year, for example, I already explained you. In previous year, what is the accounting previous year? For example, for the existing partner, January 1 to 31st December. Okay. So on the 10th month, they decided to admit a new partner. Okay. So up to the 10th month, from January to October 31, they worked hard. They get some profit. Like say for example 30,000 rupees. Okay. So how to it should be shared? It's called accumulated profits because it's a previous year's profit. Okay. On the admission of a new partner, they can't share their accumulated profit to the new partner. It's not fair. After the admission of a new partner, he has to prove himself. He has to work hard and get profit. Then only next accounting period, end of the next accounting period only, new partner get the new profit. Profit as per the new profit sharing ratio, sacrificing ratio, right? So the previous year's accumulated profit is should be distributed to the old partner into the old profit sharing ratio. So profit and loss appropriation account is to be debited. Then general reserves. Reserves are many types. What are they? General reserves, okay, and workman's compensation fund and investment fluctuation fund, etc. Okay, let's see general reserve. What is meant by general reserve? Reserve at the end of the every year from the profit partners reserve 5%, 10% for what purposes? For uncertain flood or uncertain fire, theft, loss. Okay. So some uncertain accident suddenly happened. Accident. So to face that, to handle that critical situation, that difficult situation, at the end of the every year, from their profit they reserve some percentage, like 5%, 10% fund. Okay, that is called general reserve. Okay. So reserve fund. Listen, if partnerships run, say for example, milk, flour mill. Okay. So they purchased machinery at the rate of 1 lakh rupees. Okay. So that machinery will work up to 5 years only. Okay. The machinery's value is, working value is up to 5 years. So every end of the accounting period, from their profit partners save 20,000 rupees reserve for the purchase. After 5 years they purchase the machinery. Okay. So after, at the end of the 4th year, they reserve 80,000 rupees. So each end of the accounting period, from their profit they reserve 20,000, 20,000, 20,000. At the end of the 4th year, they reserve from their profit 80,000 rupees. On 5th year, the machinery will be failed. The machinery is failed. Okay. So on 5th year, at the end of the 5th year, they reserve another 20,000 rupees. Okay. So now they have 1 lakh rupees. From that reserve 1 lakh rupees, they purchasing new machinery. Okay. So this is called reserve fund. Reserve fund also is to be, reserve fund account also is to be debited. General reserve also account is also to be debited. Then workman's compensation fund. Listen, the existing partner always reserve some percentage, 5%, 10% at the end of the every year from their profit. They reserve some percentage, 5%, 10%, 20% for what purposes? Compensation. If suddenly a workman death on the working time, okay, suddenly it happens accident to their workman. So to give the compensation to his workman's family. Okay. So for that they reserve some percentage from their profit at the end of the year, every year. Okay. So workman's compensation fund account is to be debited. Then investment fluctuation fund account. What is meant by investment fluctuation? So listen, if you run the business, say for example, if you run the business partnership from any other firm or a small shop or sole trader or a company, whatever it is, you have to insure that company or a sole tradership, okay, because of the uncertain theft, loss, fire, flood, heavy rainfall. So you have to handle that situation, you have to handle that critical situation, difficult situation. So for that you have to insure your company or partnership firm or any other shop, whether it's a big shop or a small, whatever it is, you have to insure it. Okay. So from at the end of the every year, you have to reserve, you have to invest some percentage from your profit, that is called investment fluctuation fund. It is to be debited. Listen, profit and loss account and the general reserve account, reserve fund account, workman's compensation fund account and the investment fluctuation account is to be debited and old partnership account is to be credited. Are you clear? How to pass the journal entry to transferring accumulated profit and loss and the reserve funds. Okay. Then if the existing partners get accumulated loss, how you pass the journal entry? It's a reverse entry. You have to enter it in reverse order. Old partners capital account data to profit and losses account is to be credited. Listen, if the old existing partners get the accumulated profit, it is to be debited, profit and loss appropriation account. If the old partners, existing partners get accumulated losses, from the profit and loss account is to be credited. On debtor side, you have to enter old partners capital account. Okay. Do you have any doubt? Please comment it in the comment box. Please subscribe my channel. Thank you.